So, get this. The country on the receiving end of this entire operation is actually pulling in more money right now than it was before any of this started. $30 million more. Every single day. And on top of that, it is charging $2 million per ship just to pass through Hormuz, which is adding up to billions a month. Now think about what that means while the other side is watching its stock market crater, its bond market shake, and its allies spiral into their own financial crises. Turkey just dumped 58 tons of gold in 2 weeks just to keep the lights on. Egypt is staring down a currency near 53 to the dollar, and we are talking about a country of 100 million people where bread is a staple. The Houthis just entered the conflict, which now puts El-Mandeb, the Red Sea, and Suez all in play on top of a Hormuz that is already locked down. That is potentially 26 million barrels per day of global supply at risk with nothing on the planet to replace it. Oil is at $110 and heading for $120. 150 is now being discussed seriously. 200 is no longer a joke, and prediction markets are pricing in a 63% chance of a U.S. ground deployment inside Iran by April 30th. The S&P has already lost $4.8 trillion since this started. And here's the thing, that number is looking more and more like just the opening bid. Today we break down exactly why the financial situation is far worse than what is being reported, who is actually winning the economic side of this conflict, and what the real damage could look like from here. Now, the scope of this conflict just keeps growing, and the whole Middle East has been pulled into it. Trump is still talking about wanting negotiations. Fine. But at the exact same time, he is moving tens of thousands of additional personnel into the region. Schools and universities are being hit, which is just extraordinary to think about. And Israel has kept ratcheting up its own targeting. Nuclear infrastructure, steel production, and now power plants are all on the list. Now you would think all of that would be breaking down Iran's position, but here is the thing, it is not. Every time a civilian institution takes a hit, it does not fracture support for the regime. It cements it. It writes Tehran narrative for them. Russia has not pulled back its support. China is still buying Iranian energy. The stockpiles are not running low. Iran is not a country that is a week away from folding. This is a country that is hardening. Now here is where it gets really striking, because the financial picture is the complete opposite of what most people assume. Iran is generating more revenue right now than it was before this started. Let that land for a second. The entity absorbing all of this is financially better off than it was in peacetime. They have been moving over 4 million barrels of oil a day in recent sessions. That is above their pre-conflict pace, not below it. And the price is what makes the math so staggering. Before all of this, Iranian crude was going out at $60 or $70 a barrel. Now it is clearing $100. That is a minimum of $30 million in extra daily income. Every day. And let's not forget the transit revenue. Iran is charging $2 million per vessel to move through Hormuz right now. Run that across daily shipping traffic, and you are looking at billions of dollars a month in fees alone. Iran is not getting squeezed. Iran is getting paid by the conflict. Now here is another layer. Dollar-pegged pricing is showing up in Tehran. Pizza shops are quoting prices in dollars. The regime is not on the brink of collapse. Asia Times noted this week that the conflict has temporarily handed the dollar its petrocurrency status back, since oil is priced in dollars. But Wolf Street published data showing the dollar reserve share has dropped to a 31-year low. So, yes, there is short-term dollar demand from the oil spike, but the structural foundation underneath that is cracking. Both of those things are true at once, and that tension does not resolve in a comfortable direction. Now, here is something almost nobody is talking about honestly. There are actually more financial constraints on the United States in this situation than there are on Iran. Think about that. Iran does not have a stock market to protect. There is no massive bond market in Tehran that starts shaking every time an escalation headline drops. The US does. And every day Hormuz stays shut, that pressure radiates into US allied economies. German, Canadian, and American yields have moved up 40 basis points since this intensified. British and Italian yields are up 70 basis points. That is a massive move in a very compressed window, and it is pushing US allies hard toward recession territory. and Trump spent most of 2025 burning bridges with those same allies. He cannot call Brussels or London and ask them to split the cost of this. They are not in shape to help, even if they wanted to be. Washington is carrying the entire financial weight of this alone. Now, the countries getting hit the hardest are right there in the Gulf, and what is happening to them is a double compression that is going to force this towards some kind of resolution faster than anyone is planning for. Saudi Arabia and Qatar are watching their revenue bases get destroyed. Turkey is probably the most acute example of the pressure building right now. Over 70% of Turkey energy needs come from global imports. Qatar is a major gas supplier to Ankara. But with Hormuz restricted, Middle Eastern energy is trading at a serious premium, and Turkey is already running a current account deficit of $33 billion before any of this. That was already a problem. Now it is a crisis. Now, picture how bad the full picture is for Turkey. Their two biggest export markets, the UAE and Saudi Arabia, are both in serious trouble. Turkish exports into the Gulf have fallen by over 30%. So, you are buying energy at sky-high prices that keep climbing. At the same time, your biggest customers are pulling back their spending, and your currency is under sustained downward pressure. That is a currency collapse playing out in slow motion. And Turkey is not alone in this trap. This is the fate forming for Trump Gulf partners. If this drags on, it does not stay economic. It turns political. The conditions that sparked the Arab Spring were built exactly on energy price spikes and food shortages. Those same ingredients are reassembling right now across the region. Now, if you are a gold investor and you have been wondering why prices were pulling back this week, here is what is actually happening. Middle Eastern central banks need dollars to buy energy. When your reserves are not enough to cover the import bill, you sell what you have. Turkey Central Bank sold 58 tons of gold worth $8 billion in just a 2-week window. That selling overwhelmed safe haven demand and pushed the price lower. Same dollar crunch that has played out in every major energy shock in history. But the scale this time is different. And a COT report from SchiffGold this week shows it was managed money, meaning large institutional speculators, that drove the gold sell-off in January, not just central banks. Institutional positioning is shifting too. As the macro picture keeps deteriorating, the direction of that shift is going to change the price picture significantly. And if Saudi revenues deteriorate badly enough, Riyadh could start liquidating its own holdings. Sitting on the other side of that trade, ready to buy at a discount, would be China. Now, Egypt's situation deserves its own moment, because this is where the financial crisis tips into something with far more serious consequences. The Egyptian pound has approached 53 to the dollar. For a country that imports the majority of its grain, that exchange rate is catastrophic. Egypt imports the grain that goes into the bread that is the dietary foundation for tens of millions of people. When the currency collapses, the cost of feeding the population in local currency terms explodes. And when people cannot access affordable food, history has already shown what that looks like in Egypt. It happened before. It helped trigger the Arab Spring. And the conditions forming right now are pointing directly toward that same recipe for instability. Now, for the development today that fundamentally changes the risk math going forward, the Houthis have formally entered this conflict, and that cannot be understated. Zero Hedge confirmed today that over 3,500 additional U.S. personnel have arrived in the region as this new front opened, and prediction markets at Mishtalk are now pricing in a 63% probability that the U.S. sends ground forces into Iran by April 30th. The Pentagon is preparing operation plans spanning what they are calling weeks, but anyone who has watched how these situations play out knows that weeks becomes months. Antiwar.com is reporting a major new escalation is being prepared. Asia Times published analysis on why the U.S. has not gone after Hormuz directly, and the answer is not reassuring. The operational risk is too high. But the Houthi piece is what is really making markets nervous. These are the same forces that shut down Red Sea commercial shipping for months at a stretch. Even with the full weight of U.S. naval assets deployed, they kept operating. Now, with U.S. attention stretched across the Persian Gulf, we could be looking at two simultaneous choke point crises at the same time. Oil is at $110 and moving toward $120. If the Houthis commit fully to El-Mandeb, $150 is not a ceiling, it becomes a floor. And $200 oil, which everybody dismissed not long ago, is getting discussed in serious institutional research. JP Morgan laid it out plainly today. A Gulf oil supply cutoff would be catastrophic for global markets. That is not a fringe analyst making that call. That is the largest bank in the United States. Now, let us just run the numbers on what we are actually talking about. Hormuz is already locked down. That removes 20 million barrels per day from accessible global supply. That is 20% of everything the world uses. Add El-Mandeb going offline, and you pile on another 6 million barrels per day. There is no combination of producers anywhere on the planet that covers a 26 million barrel per day shortfall. The US cannot produce it. Russia cannot produce it. Total OPEC spare capacity does not get close. The world simply does not have the production infrastructure to replace what those two choke points move. Period. And then there is Suez to the north. The Houthis have already shown they can threaten Red Sea shipping comprehensively and sustain that pressure. Suez is well within their operational range. If Suez gets added to the equation, this goes way beyond oil. Saudi Arabia is reportedly rerouting some tankers around Africa as a contingency, but that only works for oil. Everything else moving through Suez, finished goods, raw materials, machinery, food, does not have a quick alternate route. It gets stranded or priced out. And the Gulf states cannot absorb that kind of disruption on top of everything else. Now most people have no idea how exposed Gulf countries are on food. Bahrain, Kuwait, Saudi Arabia, the UAE, none of them can feed their populations from domestic production. 95% of soybeans consumed in the Gulf come from outside the region. Rice is 77% imported. More than a third of wheat supply comes from external sources. Vegetable oils and corn are heavily import dependent. The moment those supply lines get seriously disrupted, these countries face a food emergency. And here is the wild part. Iran, sitting at the center of Hormuz and the approaches to Suez through El-Mandeb, now effectively controls both the energy revenue and the food supply of the entire Gulf at the same time. That is extraordinary leverage, and it was handed to Tehran by the operation itself. Now look at the financial backdrop this is all playing out against. Visual Capitalist published data this week showing global government debt has crossed $111 trillion in 2025. The Mises Institute published analysis arguing sovereign debt has become insulated from market discipline, meaning governments have borrowed massively for so long with so few consequences that the warning signals have been dulled. But energy shocks are historically what snaps those signals back into full force. Bloomberg is reporting investors are rushing to exit private credit markets. Real investment advice, Quoth the Raven, and the Daily Economy are all calling it a potential subprime crisis 2.0. The cracks are not theoretical. They are showing up in real data right now. Chris Vermeulen put out a warnings today aimed specifically at investors over 50 who hold bonds, pointing out that duration risk in those portfolios is severely underappreciated given where yields are heading. And Market Sanity published technical analysis showing agricultural commodities breaking a 20-year resistance level this week, a 20-year technical breakout in food prices, while Middle Eastern food supply chains are under simultaneous energy and currency pressure, is not noise. That is a signal, and the New York Times published a full comparison today between the current situation and the 1970s oil shocks, and the parallels are deeply uncomfortable. Now, let us spend a moment on Trump himself, because the gap between what he is saying and what is actually happening has become a real strategic problem. He made comments this week claiming inflation is going down, that eggs are 60% cheaper than when he took office, that cheese, butter, potatoes, and fruit are all less expensive than when he arrived. And then he had that moment where he fumbled the name of the Strait of Hormuz, called it something completely different, and told the audience there are no accidents with him, not too many. That clip is circulating right now, and it happened right around the time CPAC was dealing with hundreds of empty seats and at least one audience member falling asleep on camera. That is the level of engagement at the top of the decision chain, while oil is at $110 and climbing. The real danger is not intentional dishonesty. The real danger is that if he genuinely believes the operation is going well and inflation is under control, he keeps escalating without course correcting. Every escalation extends the timeline. Every extended timeline adds to the financial damage. The Pentagon is preparing what they call weeks of ground operations, but weeks becomes months, and months becomes years. Iran has been actively signaling it wants the U.S. to commit ground forces. That is not a country afraid of this scenario. That is a country that has prepared for it. When significant losses start coming back, Trump faces a choice with no good options. Accept the political damage of a difficult withdrawal, or deepen the commitment and absorb the cost of an open-ended operation. Both are destructive, and the markets will reprice whichever path gets chosen. Now, here is where it all lands. The S&P is down over 7% year to date. U.S. equities have lost $4.8 trillion since this conflict escalated. But that reflects a market still assuming this ends in weeks. What has not been priced in is Hormuz locked for months, El-Mandeb going offline, a ground deployment being authorized, and Gulf currency pressure triggering a broader cascade. The 1973 shock dropped markets 17%. The 1990 Gulf conflict dropped them 20%. Ukraine in 2022 dropped them 16%. We are at 7% right now with circumstances structurally worse than any of those three episodes. So, stay alert, stay safe, smash the like button, subscribe, and tell us in the comments, does oil break $150 and does the U.S. send ground forces by April 30?